and all of the most important global transnational policy issues have a home at SEPA, from energy to global economic governance to sustainable development to war and peace and on and on. So I think there are a number of ways in which SEPA is poised to be the great global public policy school in the world in the decades to come. And PEPM plays an enormous role in our capacity to do that. PEPM has always been the most global of SEPA's programs. So half of our students overall are from outside the United States. 90% of PEPM students over the 20 years that we've been running this program have come from out of the United States. And you know, of course, that you've spent your time here at SEPA and your careers focusing precisely on these global, transnational policy issues. And we take great pride in that, and having provided a platform for you to do that, and having you come to us to provide a platform for us to be the great global public policy institution that I think we are. We put a great pride in PEPM's long history, the extraordinary students and graduates who have come through the program, some of whom are represented in this room, and they're your colleagues who, for whatever bizarre reason, decided they didn't want to come. But now, once you go home and tell them all what a great time this was for the 25th reunion, they'll all be here. It's one of a small, select group of programs to maintain close ties with the World Bank through a variety of programs. That's been of great benefit to the school and great benefit to our students and alumni and many of you. We've welcomed many of the leading minds in the field of economic policy to SEPA and Columbia over the years, not just our fantastic director, Professor Guillermo Calvo, but our former Columbia colleague whom you'll hear from tomorrow night, Danny Roderick, Bob Mundell, Jagdish Bhagwati, Ron Findley, Bill Easterly, Carmen Reinhardt, and others. This is just, you know, the lineup of the all-star lineup of great international economists who have thought deeply and carefully and made contributions to the set of problems that you all deal with every day. PEPM's graduates are in leading positions around the globe, intersecting with governments, development agencies, the banking sector, not-for-profit agencies, energy companies, you name it, in the world of energy, international finance and economic policy. PEPM graduates are there holding leading positions and taking leading roles, leadership roles in pushing forward for important issues. We're really very excited to be hosting this first ever reunion of PEPM alumni, and I want to pay special tribute to Guillermo and especially to David Coughlin for having put this all together. We're really delighted to have you all here, and we hope this is the beginning of a long and fruitful, not profitable, as is what deans think about all the time, fruitful relationship for all of us. For the school, as we move forward in figuring out how to grow the program and make it even better. For you, as you connect or reconnect both with us here at the school and with your classmates and other PEPM alumni who you may not have overlapped with here at Columbia. But we hope this is the beginning of the building of a deep and lasting community for this, centered here at the school. But as always, when we talk about SEPA, with arms and fingers and all kinds of other appendages out all over the world. There are SEPA alumni in something like 156 countries around the world. You cannot go anywhere and have a conversation about international public policy without running into a SEPA alumnus. And PEPM and its graduates and all of you play a really critical role in that network. So I want to just welcome you, wish you a great day or day and a half. I'm afraid I'm going to have to dash out right away after I finish these remarks, but I'll be back with you for a little bit tomorrow night at your closing reception downtown. So I wish you a terrific day. We're delighted to have you here. Thanks very much for coming.
Okay, thank you very much, Dean Lieberman. Really a very eloquent talk, and I've been left without words almost, because what I was planning to say overlaps tremendously with what he said. So I'll probably be brief. But I don't want to miss the opportunity, this great opportunity of welcoming all of you back again to your home. It's great to see you here, and I really hope that you will take this opportunity to reinforce your ties with us and among yourselves. The Dean was right, been thinking while he was speaking that it is as if we have been preparing ourselves for this moment. After all, I mean, this PEPM started in the early 90s, and imagine what people had in mind in the early 90s was the peace bonus, remember? Remember the Berlin Wall, and we were all expecting that that would be a great opportunity to improve the world welfare, and we tended to think about positive things, many of which have taken place, but we know that the reality is much more complex, and now we are in the middle of a crisis, one of the largest crises, actually the largest crisis since the Great Recession, global crisis. And it is a global crisis, as the Dean said, and as we are speaking now, and we are going to have a panel discussing these issues, we are wondering what's going to happen with Spain. Here we are, people from all over the world, and probably a topic which is high in our minds will be Spain, or maybe Portugal, or maybe Italy, and obviously, yes, Europe, and so on. And how that might problems there might have repercussions in other parts of the world, especially emerging markets where there is such a large representation here. So certainly now the globalization has come to our doors. As policymakers, we cannot ignore it's just there. And the beauty for us is that we have been preparing ourselves for that. And PEPM has been doing that business for years and years, and now we don't only have the fact that there is a program going on like this, so the new generations will benefit from that, but that we have people like yourselves, and many, and there is a network out there. So let me just say very briefly a couple of things that I have prepared. The first place an overview of PEPM. I mean, the Dean is perfectly right. I mean, we have an extraordinary group of people who have graduated from here. Just to give you some examples, we have a knighted advisor to the Crown Prince of Bhutan, director of the board of the BRD, advisors in the World Bank and the IMF, former central banks governors, finance ministers. We have a deputy governor of the central bank with us here, very happy that he could make it, CEO of companies, and so on and so forth, all over the world, not just in one particular location. What we have been trying to do in PEPM over the years, but I can speak about my term here, which started in 2007, is to meet the challenge of globalization. So we have added a strong focus on, perhaps related to the first cohorts, given the facts, given that when I came in 2007, we had already several crises behind us, so it was obvious that that's an issue we could not ignore. And we try to meet that challenge in the macro series in particular. So we have focused much more, probably than before, on those issues. And we brought first-rate academics and practitioners from all over the world to help us sort out the main issues there. And also we partner with the Bank of England. We have now on a regular basis, this is actually, we've realized the other day when they came that it was the 5th anniversary of them coming here to help us organize a workshop on inflation targeting, which is very well received by students. And we plan to continue in that. We have already some conversations going on with the IMF and the IMF Institute, and we hope to bring them here and contribute to the program in one way or another. And the last thing that I wanted to mention, that is, they didn't mention that, but let me reiterate. That we value enormously the network of PEPM graduates, you people. We are very proud of the quality and the diversity, but we feel that the network, that network is still in its infancy. We have not taken advantage of that. And I have the feeling that that's a win-win proposition. But like with any networking project, in order to get them off ground, I mean, it doesn't come up just by itself. You need some coordination. So what I like to propose is that we think of ways of improving the chances of making this grow. I mean, we have representatives from 140 countries. We have over 900 graduates out there. And David will be speaking about some specifics. But the way I see this is PEPM is the alumni platform is like a fertile land that only needs the seeds of a new idea to yield a very rich harvest. It's there to be harvested. And the world is coming in our direction. It's asking us to give answers. And so the benefit of a group like this, including all of our friends that are not present today, is that we all, in a sense, are facing the same problems. So there must be a lot of benefit from being able to exchange ideas. How to do that? Well, there are different projects, but one simple one could be workshops, for example. We have organized already a workshop here with IDB, Inter-American Development Bank, for the last 3 years, which has been very successful. But so far we have been unable to really reach out to Asia. I'm trying to, one of my projects is to bring Asia and Latin America together, for example. There's a lot to learn from the two regions. But you need to get this going, and it's not simple because we are all very busy. But since there are so many of us and we are so really excited about the project, I mean, we promise our goodwill, our effort, and as again David is going to tell you, we are ready to help from our end. So before I finish, this was the main thing I wanted to put on the table. Maybe we can discuss it as we meet and chat over these 2 years, which I'm looking forward to enjoy together with you. But that's something that I'd like to hear ideas coming from you. Maybe a central bank would like to do something like that, and we can think of ideas. I mean, we've done it already. So maybe just putting 2 and 2 together. If you have a project like that, central banks can start doing that. We can invite some of the other members of this brotherhood, and all of a sudden you have something that works very nicely. And I'm sure that today we are going to see a proof of that in the panels that we are going to have the first and the second day. I mean, ideas are going to be flowing because people are thinking, and I know how the PEPMs are. They never shut up. So, and that's a great thing. So, and I don't shut up either. So that's why it's a beautiful relationship. Before I finish, I'd like to recognize a donation from more than 10 alumni at the Bank of Japan that has just been given to us. And thank you very much for that. You're all welcome to follow suit. And David will be there to pick up the check. Now, but other than that, I mean, more seriously, I'm very happy to host you here, to welcome you back, and please realize that we will depend on you on this next stage, which I hope is going to be the next stage of PEPM, the global networking. Thank you very much.
Thank you, Professor Calvo. Well, I want to be very brief because I know we got started late today, but I just want to echo what both Dean Lieberman and Professor Calvo said about mainly the reasoning behind our organizing today's anniversary. Of course, we're happy that we're 20 years old, and we want to celebrate our existence and our history. But really, the driving force behind today and tomorrow are you, our students and our alumni, and primarily our alumni, because really what we want to do is to connect much better with you, and we want to help you connect better with each other. I mean, you are such a resource to us, to each other, to our students, that we've really been letting it go too long without having a stronger network. And so more recently, a few of the things that we've been doing, I'll just mention a few. We created a new Facebook page, or a group actually, which I hope all of you are a part of. If not, email me and we'll get you a part of it. Samantha is, I think, guarding our things outside, but she'll be in soon. She's been the manager of that Facebook group, and we're trying to put out there our events and what's going on. We also have a small LinkedIn group that we hope to expand. We're also, we've started inviting some of our alumni to come and speak to students on campus. We've had a few people do that this year. Several people did it last year. We always welcome alumni to come and speak to our students about your work, about your perspective on the issues that are going on today. Additionally, in recent years, you all know that I think we go to the World Bank and IMF each year for visits, and those are in preparation for students to gain internships during the summer, mainly at the World Bank Group. And so each year, in the most recent years, we also work with the SIPA Alumni Club at the World Bank to gather alumni together and meet with students to give alumni perspectives on that. Ispanjar, who's here today, has been highly involved in that. We always rely on him and others in the Alumni Club. And then also, much more recently, I had the opportunity to visit Chile, Colombia, and Peru, and was very pleased to be able to have alumni networking events there. A couple of you were there. I got to meet Camilo in Colombia, and I got to see Jimmy in Peru. We also had an alumni event in Chile while I was there. So we're really trying to do more and more of these kinds of things. And we really hope that you'll be interested in them and that you'll help us think about how we can do more such things. And so after our panel sessions today, oh, there's Samantha. Hi, Samantha. We'll have a feedback session where we really hope that you can participate in brainstorming about better ways to connect with each other. There's one other person that I want to introduce who's here today, and it is Maya Hadow, sitting in the back. Maya, can you wave? Maya is my predecessor and was the assistant director of PEPM for 10 years before I started in 2008. Also tomorrow we'll see Maya's predecessor, Maria Cecilia Barcelos, who was the first PEPM assistant director, along with many of our all of our former directors of PEPM and many former faculty of PEPM. So I'm really looking forward to today and tomorrow, and I thank you all for coming, and I look forward to working with you. So without further ado, let's start with the first panel. Ludwig Marek from City Capital Advisors is the moderator, and we've collected a great panel for you to speak on the European crisis and its effect on emerging markets. So please come on up, and I'll leave the floor to you.
Good afternoon, everybody. Welcome also on my behalf and the behalf of the panel to attend the first panel here at the PEPM's 20th anniversary. I hope everyone hears me well. The main focus of this panel is the European debt crisis and how it's impacting or has impacted so far the emerging markets globally. So it's not just Latin, but other parts of the world. And I'm just going to quickly want to walk through the format. We're going to do a short introduction. Each panelist is going to introduce himself or herself, and then give a quick overview of his or her perspective on how a particular field or a region has it been impacted by the European debt crisis. As we both know, the debt crisis has been raging on for about 2 years now, and there have been a lot of ramifications and consequences, and we'll be speaking about some of those over the next hour or so. I'm going to start with my introduction first. My name is Ludwig Marek. I'm class of 2007. I live in New York. I work for City Capital Advisor, which is a fixed income global alternative investment platform as part of Citigroup. And we particularly my firm is particularly looking into the European debt crisis as we're focusing on fixed income investment opportunities globally. And it's been a lot of fun and also a lot of concerns. What has happened over the past 2 years. Prior to joining Citi, I was at Goldman Sachs Asset Management for about 3 years actually, in a marketing and product management role, overlooking their fixed income products and also money market funds. And prior to that, I was a Bloomberg reporter. Yes, so be careful what you're telling me. Covering international investments and international investment strategies, particularly for U.S. investment houses. I'm going to pass along to Camillo, and then we'll have each of them do a little bit of introduction and also their viewpoints. And after that, we're going to discuss certain overarching themes that we believe are valuable to discuss here at this forum. And after that, we would like to reach out to you, particularly, and see if how the European debt crisis has impacted your work environment or also your, policies at the place you're at, and also in terms of your experiences overall, whether it's family or also in terms of from a private or personal point of view. So, Camillo, no further ado, please continue with the introduction.
Thank you. My name is Camilo Soto. I am a PEPM class of 1995. I guess it's the third class right after this start. I do investment banking down there in Colombia, so I help public policy to be executed. I've been running my business right after I went out of this school. Professor Guillermo Calmo and David, thank you for joining us today here. Being in this class, in this room, reminds me and gets me back to those days in which I was a student here. And particularly during those days, we started our marriage with Olga Lucia, who is with me today. I'm an economist. I hold a bachelor's degree and a master's degree of Universidad Los Andes at Bogotá. And I've been also a professor of the business school for the last 17 years. I'm delighted to be here. Thank you.
Hi, my name is Anjali Varma. I graduated from PEPM in 2008. At the moment, I work for Macquarie, which is an Australian investment bank, and I'm looking after country risk primarily for Latin America. Am I not close enough? Thank you. Which means that I spend about 25% of my time doing sovereign risk analysis and the other 75% of the time looking at specific transactions in Latin America and how the country environment might impact those transactions. Before that, I worked for IFC in Hong Kong doing loan syndications, and before that with Lucent doing treasury. Also have a master's in finance. Shall I go into commentary, or should we?
Yeah, you can go ahead.
Sure. So Ludwig had asked us to start with a bit of commentary to help with the Q&A later. And I thought maybe one topic to talk about is how the Eurozone crisis has impacted the Brazilian real recently, and one of the taxes that the government has been using to try and mitigate that effect. As a result of all of the cheap liquidity into the Eurozone, a lot of money has been coming into Brazil, and it's really short-term, hot money, so to speak, and it's causing an enormous amount of Brazilian real appreciation. So the tax that they've been using primarily is the IOF tax, the financial operations tax would be the translation. And by way of background, this is a tax on certain types of capital controls, capital inflows. For example, foreign borrowing, so it could be foreign loans, or it could also be bonds issued by Brazilian companies abroad. And they've been playing with the rate of the tax, what types of transactions it applies to, and what's the minimum maturity that you need to achieve to avoid the tax over time. So as a result of all of the cheap money flooding into Brazil, the president has decided to adjust this tax, and it's a 6% tax, which they have now increased the minimum average maturity on the loans from 2 years to 5 years in order to avoid the tax. They've also changed the types of transactions that it is applied to. The one that's quite interesting for us at Macquarie is that it now applies to pre-export financing. So in other words, farmers who are growing their crops need financing while it's growing, and then once it's harvested, they repay the loans with the export revenues. It used to be that that type of financing was exempt from the IOF tax, and now the only way to get around it is if the financing company is the actual entity purchasing the physical crop at the end. And although the intent of this change was to help prevent the real appreciation, there's a lot of unintended effects as well. For one, there's a number of banks that have had to step away from pre-export financing because the 6% wipes out all of their profits, and they're not set up to actually import the physical goods. So there will be a reduction in the number of people who can provide liquidity to the farmers. And then it's giving a great advantage to the few companies that are set up to do crop importation. So with that, I'll pass on to my next panelist.
Hi. Good afternoon. My name is Alberto Rigoni. I'm class of 2006. I work for UniCredit, in particular for UniCredit Leasing, where I'm trying to support the business generation through the bank channel in international market perimeter, which for UniCredit means mainly Central and Eastern Europe. UniCredit is pretty strong in the emerging Europe. We are in 22 countries, and we have leadership position in many of those countries. The fact that I'm from Italy and I work for one of the 29 largest financial institutions in the world, so entitles me not to talk of the European crisis, but I'm going to focus on investment in Central and Eastern Europe and why, at least I believe, so attractiveness of investment in this area, at least with a long-run perspective, has not been affected by the financial crisis, and in fact it's the opposite. And so that's pretty much what I wanted to say.
All right, thank you. My name is Isfandiar, class of originally 2001, but I graduated in 2002 because it took me 2 years to finish a one-year program. I took a year off, so I don't know how that happened. Sure, there you go. All right. At the moment, I work at the World Bank. I've been there since 10 years. Before that, I was at Salomon Brothers in New York. I cover mostly Europe and Central Asia and the financial sector in these countries. Basically, just a quick snippet. For us, the crisis has been pretty good in the way, since we're the counter-cyclical lender. So when UniCredit pulls out, the World Bank comes in, and that's in a way good for us. Also, the World Bank and the IMF is a gathering body and has a lot of convening force. So whenever there's a crisis, there is more demand on coordination and making everybody talk to each other, and the World Bank kind of plays a role in that. So that makes it a good place to be these days. Quickly, in terms of the view on the region as such, at least from where we sit, we don't see any short-term recovery happening, nor even medium-term recovery happening, and we'll kind of talk about that a bit later on. And that's it.
You want to do yours now, or?
Okay. Well, I was invited to answer the question, what did LATAM to avoid the deep recent financial crisis? Now, let me tell you that to do so in 5 minutes seems to be a tough matter. However, here's my attempt. A little bit of background. LATAM economic situation before and during the crisis. There was a notable price increase in primary goods, especially hydrocarbons, derived by the dynamic of the world's GDP. This led to a 145% increase of goods exports in LATAM and the Caribbean between 2002 and 2008. There was an upward trend of FDI, reaching the record level of almost 100 billion in that year. A strong increase of remittances, which increased from 23 billion to 69 billion between 2001 and 2008, accounting for almost 2% of GDP of LATAM. All these elements allow an average annual growth rate of 5%, the second highest growth rate since the period 1967-1974. Per capita income had an average annual growth close to 4% between 2003 and 2007. And particularly, unemployment decreased to a level below 8% after 2007. And there was a clear poverty reduction from 221 million people in 2002 to 180 million in 2008. So poverty index decreased from 48% to 33% between 1990 and 2008. And finally, contrary to what happened in DM, in LATAM there were a few cases of wrong investment or funds lost in the housing market due to low innovation of financial markets on derivative instruments and a strong regulation on banking institutions. That is a key issue, a strong regulation on banking institutions. Nevertheless, it came the crisis through different channels. Declining prices of raw materials, international credit lines were abruptly reduced, and consumer paralysis. During the last quarter of 2008 and the first of 2009, the Latin American GDP suffered a contraction of more than 3%. Which measures were taken by LATAM to avoid and mitigate the crisis? And this is the key point. The region showed unprecedented strength. The response of macroeconomic policy at this time was essentially contracyclical. especially in those countries with solid economic fundamentals. On one hand, strengthening the social safety nets through programs of conditional transfers. In Colombia, there was a specific case called Familias en Acción that made the difference for us and the very poor people in the country. Those policies were developed, and in terms of the fiscal policy, many programs of increased spending oriented to the construction of public works and employment generations. And in some cases, governments eliminated taxes to stimulate consumption or specific production activities. Such strategies, equivalent to almost also 2% of regional GDP, were made possible by the improvement institutional capacity, previous savings, and responsible management prior to the emergency. In the front of monetary policy, central banks reduce, first, in the intervention interest rates in order to decrease credit cost. Low inflation rhythm allowed an important space for this policy. Central banks made efforts to provide liquidity in domestic and foreign currencies and made changes in reserve requirements. That is the case of Brazil, Argentina, Peru, and Colombia. Besides, multilateral institutions, particularly the IDB, adopted measures to increase immediately the flow of resources to the region. These measures, the stimuli programs adopted, and the normalization of financial markets made possible an initial recovery during 2009. In 2010, the crisis was overcome, thanks to the recovery of the global economy, but especially thanks to the recovery of LATAM major export markets. Economic growth after 2009's construction was 5.9%. Per capita income growth, 4.7%. Poverty index, 32.1%, the lowest in Latin American history. And unemployment, lower than 7.6%. And more important, from my point of view, there was a clear reduction of inequality. Two leading factors explain this. First, reduction in inequality in the distribution of years of education, which led to an increase in relative returns of unskilled people. Second, the government transfers becoming more progressive and more generous explains the decline in non-labor inequality, which was also one of the predominant factors in explaining the decline in overall inequality. And this is the most important thing for us as PEPM students, PEPM graduates. This leaves an important message. Public policy matters. There is a connection between non-labor component of income, declining inequality, and public policy. Finally, LATAM perspective. I don't know if you wanted to leave it by the end or for the end, or now we can share.
We'll have a Q&A afterwards.
Okay.
So if you
So let me just finish with this. The perspective. Economic growth, poverty reduction, changes in the size and composition of households due to lower fertility rates, dependency on major participation of women in the labor force. All of them have contributed in the last 15 years to a general increase in the average household income. We have a middle class increase in participation in the economies, and therefore allowing major stabilities to societies, generating new resources of growth and progress due to rising consumption patterns and schooling levels, promoting social mobility and strengthen domestic demand. This clearly can lead to a more varied and productive structures and to a virtuous circle of skill employment generation and expansion of wealth. Those old measures made the difference in order to avoid the deep financial crisis. 5 minutes, it was a promise. I done it.
He is an investment banker, guys, so just if you know. Thanks, Camilo. Appreciate your insights on, particularly on the Latin American region. One of the first questions I want to ask the panel is really in terms of what we've learned from past crises is that usually regulatory bodies and as well also the regulatory environment changes. And it changes, we've seen it for instance here in the US with the Volcker rule, We've seen it globally with Basel III. We see it in Europe with Solvency II, which is for the insurers. My sort of question is, in terms of just looking at these regulatory changes and how they're impacting the financial institutions, which clearly 2008 partially was driven by the financial institutions and their leveraged balance sheets. How did it actually impact each of your regions, whether it was in terms of flow of capital, in terms of investment strategy, but also in terms of actually has there been, have the monetary policies and the fiscal policies actually followed suit with these regulatory changes? Or as Camillo sort of said, well, there's a counter-cyclical monetary policy in place that actually allow, for instance, certain Latin American countries to avoid the crises. What would be, Alberto, for instance, in the Eastern European regions, what do you think was the impact there?
Well, just let me maybe focus a little bit, because I think there is a strong correlation with, so as I said before, the attractiveness of investment. So because I think, so these kind of changes eventually will end up to clarify, to split, if you want, arbitrage and short-term investing opportunities, or if you like it, investor looking for high return to the one that want to focus. So I think that so this kind of new framework will improve, to go straight to the bottom line, so to invest in a country if it's reasonable to do. And from this point of view, as I said before, the crisis actually did not worsen the attractiveness of investment in the CE region. Why? Let's just go back a little bit, maybe to I'm a little bit embarrassed to talk of FDI in front of most likely the greatest expert in the world about of this. But I'm sure that you cannot take back my graduation. So I'm kind of relieved, so I can freely talk. So if we are just trying to clusterize the reason why you should, as a company, invest in a certain emerging market. So you have basically three clusters. One, so if you want the macroeconomic point of view, so if you want a country-driven, then you have the microeconomic point of view, if you want company-driven, and then you have a certain institutional setting that can facilitate investment in a country. Well, from both these three perspectives, the crisis actually did not change the attractiveness of investment, because the macroeconomic point of view, so if you are looking to, for example, GDP growth rate, so well, actually, CE region was affected as anyone else in the world. Maybe the only difference is that if you are coming back to 2009, for example, pretty much everywhere in Europe we were minus 5%. In the CE, on average, we were minus 5%. While there were countries such as Poland, for example, so we were plus 1.7, and so you were ranging from plus 1.7 in Poland up to minus 18% in the Baltic region. So in that sense, it means that, so first of all, you have a quite heterogeneous area, but anyhow, in some part of the area, quite strong and quite tough and quite resilient, much more than the Western countries. And on top of that, in fact, if you're just considering the forecast for the next few years of the CE region, so of course the average growth rate is lower than the one before the crisis, but it's 2 times higher than the one in the Western countries. Then, so let's just focus a little bit on the public finance. Public finance basically it's not an issue, because many countries, so they have a much lower public debt compared to Western countries, and there are cases of course, budget deficit, but still, from one side you have a low public debt, you have growth, so the budget deficit, to me, it's not an issue in this moment, and so if you want to invest, basically you can expect that taxes are not going to rise significantly in the next few years. But in fact, if you're, I mean, you know, there is a metric that can help you to understand the country risk. And if you are looking at CDS, in many cases, CDS in emerging Europe is significantly lower. I mean, in Czech Republic is 100 basis point. In Russia is 200 basis point. So these are numbers that actually are quite attractive. So the market is not considering the region as risky as sometimes you have the perception just by reading, newspapers.
I agree.
Then, so if we move a little bit on the macroeconomic point of view, so you can split the decision to invest basically from two different points of view. Either you can be a market seeker, so you're a company that you want to invest in a certain country because you want to get the demand, the local demand of that country, or either you can be an efficiency seeker, so you are looking to some efficiency saving in terms of input cost, which typically are energy, raw materials, and labor. Energy and raw material, honestly, in C region, apart from some notable exception, for example, Russia, but typically they are not the reason why you should invest in C. Labor is one of the key reasons why you should invest in CE. And from this point of view, actually the crisis was it's quite difficult to say, but it was an improving factor because up to 2006 and 2007, economies were overeating and so did wages. Now, so the crisis, from one side, company pushed to some restructuring which improved productivity. From the other side, the crisis stopped wage rise, so the real wages declined. And then if you're looking to institutional setting, and then we can quote the usual metrics, you know, the World Bank Transparency Index, corruption and whatever. So first of all, you can check that so they are not worse as other European countries. And then mostly they did not change compared to the ranking before the crisis. So to my point of view, so attractiveness is not changing. And if to me there is a very clear example that I can quote to explain this argument, and it's the automotive sector. There are a lot of producers that are relocating or at least opening facility in the sea. Please keep in mind that the automotive sector is very complex. Is by far one of the most complex industrial sector in the world. Maybe it's second only to aerospace. So if you are doing investment and opening facility in that industry, it means that you are betting. So it's it's not just doing textile, which is much more easy. So if you're looking, for example, to the 10 largest car producer in the world, so they all have facilities in Central and Eastern Europe, and on top of that, so just to quote you a metric, like 6-7 years ago, only 15-20% of the cars sold in Europe were produced in Central and Eastern Europe. Now we are 1/3. So the crisis actually pushed companies to shut down facilities in Western countries and invest and improve and strengthen production in the sea. And this trend did not change with the crisis, and it's exactly in line with what is happening, for example, in here in North America with Latin America. So if you plot the chart, it's exactly the same trend. So there is also, if you're looking to Asia, this is even higher, but because of China, and it's not fully representative, because I mean China is really becoming one of the largest car producers. So just to quote you, for example, in 2009, the number of cars produced in China were exactly the same as Japan. In 2010, it was two times as much. So they doubled the production. So they are like 18 million cars in 2010 versus 18 million versus 9 million. So this is impressive, and this is, I would say, biasing all the metrics with this kind of analysis. But anyhow, so that's why I believe that eventually, so once the liquidity crisis, because honestly, in this moment, the issue is liquidity. And once the liquidity crisis has been fixed, so I have no doubt to believe that so investment is going to flow back in the C region.
It's fun, Joe?
Sure, thanks. Firstly, I mean, just to bring Camillo's point again, we have to remember, first of all, from where the world stands today, a lot of countries in the Baltics and Southeast Europe were not where they are right now. A couple of years ago, there was massive expansion of credit, the levels of employment, the levels of poverty greatly reduced. But things have kind of changed, and at least the terminology that we are using is called the new normal. So things that used to be normal a couple of years ago are not normal anymore. So the base has changed altogether. But since we like numbers, so let me kind of give you the counter argument based on numbers. In terms of the regulatory requirement, the number, all the tests that the stress testing was done on the European banking sector, they have a shortfall. And the shortfall is around $300 billion within these European banks. Where does the money come from? For example, UniCredit or any of the Spanish banks, they've been told to kind of concentrate on the home environments. So what we see essentially is where the money is going to come out from is the emerging markets. And the banks have to raise money. So that's a regulatory requirement for Basel III. That's a regulatory requirement by the European banks, so by the regulators. So if you are a European bank that's very exposed in the emerging markets, you have to raise capital to just operate, because you have to operate. You can do it two ways. One way, you go raise equity on the market, but you can't do it all the way to reach the shortfall. So even if you raise 20% of it in the market, you would still have to, and I was just doing the numbers right now, you still need around 140 billion euros. And that's our estimates, which is going to be coming out of the emerging markets. Now, when you have around 140 billion coming out of the emerging markets, and this is a very, very conservative estimate, who puts in the shortfall? I mean, the government might put in the shortfall, but obviously the government, even though it has some fiscal space, doesn't have that much fiscal space. On a longer term view, if you look at the European banks, they're 18 to 20% times their equity. So their value is 18 to 20% of their equity, compared to the American banks, which are usually 10%. So people think European banks are more safe, but not really. At 20% equity, they're not that strong. So let's say they have to come to 12% equity, which is supposed to be a good number to have. Then the shortfall is around $850 billion, euros. Now, where is that going to come out from? It's again going to come out of the emerging markets. So at least in my personal view, I think the emerging market is going to feel a lot of the push out. I'll give you a specific example. I work in Bosnia. We have a client in Bosnia that was working with one of the foreign banks, not UniCredit, some other foreign bank.
Maybe Austrian one.
And as a business, when you operate through working capital, for example. So you have a revolving line of credit. The bank says, okay, you have $1 million. You keep getting it renewed every 6 months. All of a sudden, this foreign bank decided to cut the line, even though it was granted, and didn't even raise interest rate because it wanted money back in headquarters. This guy, had he had none of his own cash in his pocket, his business would have wrapped up. And this is just one example from one country. So a lot of these companies that are the backbone of these economies, small and medium enterprises, don't have the clout to go abroad, are going to feel the retrenchment. So in a way, when all these new requirements will be there, we do feel there is going to be an impact. And in terms of specific requirements also, and it's just the last point, there are 19 systemic important banks globally in the world, and they are supposed to do a living will, which means a recovery and resolution mechanism for them by the end of the year. Only one of them has actually submitted a draft. So what has happened is with the European central bank providing a lot of liquidity, it has made, in our view, all the banks relax a little bit, so they don't feel the pressure to kind of fix the house in order. This is one example because they haven't done anything right now. And so that's just it.
If I just maybe can add
Sure.
one word on this thing, so I can quote you the experience of UniCredit, because as you know, we are one of these systemic financial institutions, and we did that. We did increase and raise capital, and that was done through pure market operation. So it was a normal. It was a huge. It was a very, I would say, a very strong decision from the CEO and the board of directors to go in January, so in a very volatile market, but still, I mean, the capital was fully, the shares were fully subscribed. But it was and most of the money were coming from from European market, with some investor coming from the Arabian countries.
It wasn't specific to UniCredit.
No, but I just was telling you that. So we got, we got the money from the market.
We're all friends here, so. Camille, do you want to add anything to the discussion, or?
No, it's okay.
Okay. Since we are talking about, and it's particularly with István Györ's point in terms of the financial institutions and particularly the ECB floating or actually pushing a lot of liquidity into the European space right now, the two long-term refinancing operations that we saw so far flooded capital about $1 trillion, 1 trillion euros, sorry, $1.3 trillion dollars into the market. My question sort of is, we saw that the banks are hugging the money, they're hoarding the capital, they park the capital, they refinance their own balance sheets, basically. And the actual liquidity crisis, as Alberto was mentioning, stays put. So basically we are still have lack of credit, lack of liquidity in the European space, in the Eurozone, which always is going to be difficult for consumers. My question is sort of like, from an intermediary point of view, if the bank is less or more risk averse, doesn't want to actually lend out money, doesn't want to go out to small and mid-sized businesses because they are high risk at this point, because of what's going on in the European zone, how does that translate it into other regions? Do you see that some of these operations have started to slow down, that the risk averseness is so high that it impacts some of the economics in emerging markets? Anjali?
Yes, I think I can pick up on what István Györ was talking about. You mentioned the Spanish banks and how they're being asked to pull back, and it's been interesting because I've looked in Latin America, a lot of the financing comes from the Spanish banks, so that was something that we were concerned about. And if you use Mexico as an example, you actually see quite the opposite. So if I step back for a second, the BIS measures foreign lending, and they split foreign lending into two categories, the cross-border lending and the lending that's coming from foreign-owned subsidiaries that are sitting in the local countries. And the distinction is important because I think the concept was that cross-border lending could dry up faster than the foreign-owned subsidiaries because it would be a major shift in strategy for them to move. And I mention that because it's relevant for Mexico. 6 of the 10 largest banks in Mexico are foreign-owned, and they represent 70% of the bank assets in Mexico. The 2 largest ones by far are the Spanish ones, Santander and BBVA. And in the beginning, we were concerned that there might be some pullout given what's happening in Spain, but actually what you see is the opposite. And the reason being that Mexico represents such a large percentage of profits for them. For BBVA, I believe Mexico represented 40% of their profits last year. And for Santander, I believe it was 10%. More anecdotally, from my experience at Macquarie, I was at a conference last week with a bunch of country risk people from 20 different banks. And I found it interesting that no one was speaking about deleveraging. No one was talking about how do we get loans off our balance sheet. What they were talking about was how do we risk transfer country risk. So whether it's macro hedges through buying CDS, or if it's transaction specific, so things like purchasing political risk insurance, relying on letters of credit, structuring your transactions so that there's offshore collateral or parental guarantees, and really using those as more ways to mitigate risk and continue being aggressive in emerging markets.
It's funny. Do you agree with that, or?
No, I completely agree, and that's the tricky part, where you have economies such as I mean, Mexico I don't cover, but I cover Croatia, which is a very, very strong economy. In that case, the banks stay on, and the issue is when an economy is weak. So it's like a double-edged sword. When you're doing weaker, then the incentive for the bank to stay is a bit less. So there is that element there.
Mm-hmm, mm-hmm. Okay. Camillo?
It's quite interesting that I feel like being in a different world. Colombia is really growing. Optimistic is the nowadays preferred word, taking into account that we were 20 years ago in a state that basically didn't have future. Just let me give you an example of personal loans. Personal loans are growing over 30-35% per year. I'm a member of a board of directors of a bank that is a personal banking focused bank, and it's growing almost 40% per year. Corporate loans are growing over 25%, which means that in real terms, the credit is growing over 22%. Of course, central bank is definitely worried about overheating. So intervention interest rate is growing. We were around 2.5% a year ago. Now we are going to be around 5.5%. So the question is there credit risk aversion in Colombia? The answer is no. We are in a totally different situation. Middle class, increasing consumption. Middle class doing social mobility, which definitely it's an opportunity. I, in my day-by-day basis, basically attempt to answer questions of investors looking for new opportunities. Coming from where? Basically, Spain, Italy, Northwest Europe, but they will come, for sure.
Let me jump to the next point here, and I think this is a great, actually, segue into the third point that we're trying to make here. You just said, I mean, these are really very bullish numbers, and obviously the overheating is an issue, particularly when you have such strong growth numbers. And if you look at the monetary supporting policies in the U.S., in EM, I mean, here we have a 0% interest rate policy. Europe is lowering, and they're not going to go up anytime soon. Is it possible then that exactly these banks and other institutions are going to, because of this low yield environment that we're in right now, that are going to seek investments, long-term or short-term, and Anjali already actually talked about it in the introduction, that hot money, that we're looking at the carry trades, for instance, on the interest side, whether it's hard assets investments in Latin America, whether it's energy, commodities in general. Is it then possible that because of these great yields you can get somewhere else, that the European debt crisis pushes these institutions even further into the EM markets rather than actually out? Anjali?
It's absolutely true that there are carry trades happening in Mexico and Brazil, taking advantage of the 9.75%, I believe, is the policy rate in Brazil, and about 4.5% in Mexico. And so you do see a lot of people taking advantage through interest rate arbitrage. Thank you. It's a bit of a different instrument than taking a loan. So when we look at carry trades, they're much shorter maturities than if we were doing a lending.
Right.
So somewhat different dynamics. As I mentioned, Brazil is trying to counter people doing carry trades through their IOF tax. And I did want to mention that this is not a new phenomenon. We saw in 2007 that emerging markets were flooded with short-term hot money, let's call it. And that was a result of the US dollar depreciating 10% against its major trading partners. And so there were several countries, including Colombia and India, that imposed capital controls to try and prevent the money from coming inside. And I know in Colombia, they put in a requirement that investors in stocks or bonds had to put a 40% deposit with the central bank and hold it there for 6 months. And in that way, they prevented peso appreciation. And then in 2008, they were able to start removing that. And I found India did something very similar. And the IMF actually commented that they thought it was a very valid way of dealing with short-term, sudden capital inflows.
Alberto?
I'm in a difficult position to...
No names, please.
No, I mean, for sure. So honestly, I really would like to focus much more on the real side. So what you are mentioning, so this is possible. So you could have this effect in the short term. But even, I mean, so if you are just considering that you have cases in Spain or in Italy, you know, where so banks could get loans from ECB at 1%, and they can buy Italian bonds or Spanish bond with a higher return. So this is going to, but to me, so at least, so my view, this is going to be a very contingent situation.
Mm-hmm.
So, and this is not going to last. So, and eventually. Just only the sounds aspect will come up.
So do you think it's a short-term phenomenon for the time
Absolutely.
being? Yeah. Okay. Isfanjar, do you have anything to add?
Nothing much to add. I mean, we've seen the same thing. For example, in Nigeria, the government had concerns that they're offering 16% right now, and since it's oil-based economy, their currency is pretty strong.
Yeah.
And they don't really know how to deal with it.
Okay.
But I kind of agree with Ludwig. I don't think it's a permanent thing, just a short-term thing.
Okay. One last point I want to make in this panel is about EM, emerging market decoupling. 2010, we saw a lot of strong signs. Investors were very positive about, you know, Colombia and Brazil and China in terms of really being self-sustaining economic growth without the dependence of developed markets. And I wanted to hear from you guys whether this EM decoupling is going to take place. Has it been pushed back because of the European debt crisis, or just because of the European debt crisis, the forces have even become stronger for these particular emerging market regions to be actually more self-sustaining? As Camilla just mentioned, I mean, you have personal income and growth in fabulous rates right now, and I know for a personal experience that Brazil has managed, or was able to manage, actually to percolate, let the petrodollar percolate into its own domestic economy. Financial sectors is growing, and so is also the credit, and in terms of liquidity availability. So, where do you see this going in the next few years, Anjali?
I think the crisis has given a good opportunity for Mexico and Brazil to prove that they are somewhat decoupled from the Western economies. Both countries grew at roughly 4% in 2011 compared to 1.7% in the U.S. And I think one of the most obvious reasons is that exports as a percent of GDP was quite small in both countries. In Brazil, it represented only 11% of GDP. And exports in Mexico represented about 30%, which sounds like a big number, but is actually quite small if you compare it to their counterparts in Eastern Europe or in Asia, which are more like 70%. So what's driving it? I think it's really domestic demand, very similar to what Camilo was talking about in Colombia. You see growing middle class, and you see a very big expansion of credit from the banks in both countries. In Brazil, I had some of the key figures here. In Brazil, credit growth averaged 23% between 2008 and 2010, which is an impressive number. And if you look at credit to GDP, it jumped from 25% to 37% between 2007 and 2010. In Mexico, it hasn't grown as quickly. I think credit growth is about 15% for the year. But in both cases, it's really credit growth in the countries that has helped to bolster domestic demand and led them to grow, even when the Western economies are not.
Camillo?
You want to continue? I just mentioned the path, the growth path, definitely will last in this region. The increased foreign direct investment that we have faced definitely made that, for example, every single IPO is oversubscribed.
Okay.
The interaction and the way that the markets are playing together definitely represents an opportunity for capital markets, for capital to land in this region. So the word is optimistic. That is the way we basically summarize this.
Okay. Alberto?
Yeah, maybe what I just want to, so just referring to Central and Eastern Europe, in the next few years, so my perception is that most of the growth will come from private sector and from investments, because the consumption maybe will be affected. You know that there was a phenomenon in many countries in Central and Eastern Europe where typically people used to get mortgages in foreign account, so in Swiss franc or but mainly in Swiss franc. So in these cases, some countries they come up with specific plans to fix this issue, but still, of course, this is affecting. This will affect consumption for a while. So but nonetheless. So we believe and we expect that the proximity with the Western market and the efficiency that you can get if you invest in the sea region will nonetheless keep the economy growing quite well in the next few years.
Isfanjar?
I mean, I wouldn't paint it with a wide brush stroke as such. I think it would depend on the country. I'm going to give you a specific example. For example, Bosnia and Croatia, I mean, most of their trade is with the distressed Eurozone. So until the Eurozone improves, chances of them improving would be a bit less. If you look at Albania and Montenegro, for example, their banking sector is very dominated by Greek banks. So obviously that's a very contagion effect there. Montenegro has 35% non-performing loans. And that's a large number for any economy, right. So, but for them to kind of recover will take some time. But on counter side, let's say you have Kosovo. It's in Europe, it's kind of integrated, but they get their money from remittances, and all of Kosovars happen to go to Germany and Switzerland, which happen to be doing well. So then Kosovo kind of stays okay. And then you have places like Turkey, which luckily, since Europe's been giving them the boot for a couple of years, have started looking eastwards, and their economy is now growing based on the Middle East. So I would just be a bit more cautious. And it would depend on really much on the country these days.
So it's more of an idiosyncratic sort of
that's in my view.
Approach. Okay. Well, this pretty much concludes the panels and Q&A, but I do want to actually ask a little bit also in terms of the audience what their feeling or perspective is in terms of the European debt crisis. I mean, it's been going on for more than 2 years. We've just, as I said, mentioned in the panel, have had two successful long-term refinancing operations by the ECB that resulted in a rally in the markets, whether it's fixed income or equities. But long-term, how do you actually see some of these, the European debt crisis to pan out, but also how it will actually continue to impact your regions and your interest, field of interest, basically? Has anybody some feedback? Or questions for that matter?
Thank you very much for your comments. I'm Gonzalo Salgado. I'm from this year's student. Right? This is my first time, so thank you, David. Thank you very much for your comments. You know, I would like to ask you a little bit about, basically this is a global program. As Dean said, you know, we are in a global program. And the other one is, this is PEPM, so it's policy making. So when we talk about South America and we see GDP growing, we see GDP growing in Colombia, of course, but we see GDP growing in Argentina with Kirchner. So there you have I feel everybody's growing. China, that we didn't mention too much, is like a saint here. But what happened in the policy side? We have countries that from a political point of view get me very nervous. I mean, Argentina, when it comes to economy, I'm sorry, Professor, you know, whatever can happen, whatever you can expect can happen there. Then Peru is performing very well, but we were a little concerned with Humala, which trend he will have. Chavez, well, he's going from Cuba, no problem so far, but Chavez, you know. South America, from a political point of view, is getting into an area that it's a little gray for me. But we are healthy, thanks of all this export and export. So I would like to see the economy view. The numbers are very strong. What about the policy? Because we need to think globally here in this program. And the other part is China. China is decreasing. It was 10% 3 years ago, growing 9%, 8%, maybe 7%. What happened when China goes to 5%? So, okay, we can survive Europe. Europe has a deep problem. It's going to take more time, you know, has structural things that have to resolve. But how's that going to impact United States growth, China growth, and so South America? And are we prepared from a political point of view? Because Europe is getting it worse. I mean, Sarkozy, we don't know if he's going to be elected. The new government, we don't know what's going to happen. We don't see that the Italian government has enough power to do the change they want to what they want to do. Political elections are coming, and we don't see in Europe that strong things. I mean, change have taken more time from a political point of view than what we hope.
Okay.
Thank you very much.
Thank you. Camille, would you, or Anjali, do you want to go to Latin American first?
Sure, I can at least respond a little bit to Argentina and to Peru from the perspective of how we look at transactions. With Argentina nationalizing YPF, that was obviously very significant, and the concern is that the PRI market is drying up as a result. So normally we would say, okay, maybe we can have some appetite to doing project financing in Argentina, but with the right protections in place, like political risk insurance. But because of YPF, PRI is either not available or the rates are very expensive. So I do think that there will be a reduction in investment into Argentina as a result of the nationalization of YPF. For Peru, it's been quite interesting. So when Humala was first elected, you saw CDS spike, you saw political risk insurance was actually withdrawn for a couple of months. It's now come back, and I think just yesterday Humala dealt quite well with the Mingas-Congo mining project, and it seems to be trying to balance the issues with the local protesters and the environment with trying to be supportive of the business environment. So I feel like in Peru we're still confident, we're still moving in, but purchasing political risk insurance where we can, and looking very specifically at the environmental issues of each project to see which are more likely to be targeted.
Just add a few comments on Europe, and disclaimer, I'm talking only on personal, so this is a personal statement. Now, as an European, of course, and as an elector, and as an not as a banker, but as an elector of a country in Europe. No, I think you got the point, because in Europe, as I mean, everybody knows, we do have a problem of leadership. What I may argue, and in fact, Italy is the example. The current government, you know, basically it's a technocratic government. So I mean, situation was very, very complex, and apparently it looks like the politics gave up its role to the technocratic government, who in fact, in I would say 3 months, did much more than all government, center-right, center-left, in the past 20 years. So Professor Monti took over, I think it was end of November. By 15 of December, so we had a major change in the pension system. So in 2 weeks, we changed something that was under discussion for maybe 30 years. And the same is happening in terms of some sort of liberalization, and in particular for the labor. The point is that and this is, as I told you, my perception. So we do need to get someone at least not focusing for a while and not being worried of being re-elected, and at least to do what it has to be done. And for example, I don't know if there are German people in the audience, but honestly, so I can talk easily and freely about Germans. Okay, thanks a lot. And so, so in this moment, the German government, Frau Merkel, she's pretty much concentrated on the next year re-election, and she's not accepting, so for example, Eurobond could be a solution. No? So we are entering in this, to me, again, personal statement, nonsense fiscal austerity, which is really creating a tremendous problem in countries like Italy, or if you want, like Spain, but even Greece. Okay, they cheated, so they presented wrong accounts. But you cannot force an entire country to stay on the knees. This is totally a nonsense. So, and you know what? I mean, the GDP of Greece is 1.7% of the GDP of the overall euro area. So it's nothing. It's a blip. So, you cannot jeopardize the whole architecture because you are concentrating on next year election. So you have to do, and because, they're just checking polls, and the polls, I said, the majority of German people, they do not accept, I would say, supporting, the weak countries. This is a nonsense. No? Okay, so that's why. Honestly, I believe that the problem of leadership in this moment is the real problem. It's not a problem of the right economic policy, the right regulation. Of course, this is all true, but you need to go back to the origin. The origin in this moment is that we lack leadership, so let's hope. I don't know. Let's see what is going on.
Camille?
Yes, not a political position, but a practical position, or a hypothesis. Due to the fact of the middle class increase that Latin America is facing, it seems like the political trends doesn't matter. It seems. In 15 years, GDP per capita will double, which basically opens a space, a broad space for investment, no matter what political trend every country will be facing. That is basically what is going on.
Thank you, Camille, for your insights. Anybody else have any questions? George?
Thank you. Well, I'm Jorge Duarte from the Cape Verde Islands, PEPM 2003. Well, basically, my question was already answered by Alberto, because being a small country like Cape Verde, and with very tight relationship with European Union, the monetary policy is basically linked to the Eurozone. Our currency is pegged to euro. We feel that the EU problem is not only the debt crisis. And basically my question was to the panelists, what do they think? What do you think about Europe as such, European Union as such? So basically Alberto has answered the questions, but maybe something else can be added. Thank you.
Well, I like to add something from my experiences covering the ECB when it actually from its ground up, and Duesenberg was still the governor there. And one of the first questions we've actually asked was Wim Duesenberg, first press conference ever. And we asked him, doctor, as in Europe, we have to say doctor, so Dr. Duesenberg. How will you handle a centralized monetary policy when you have Ireland going with a 6% inflation rate, but then you have Spain that is basically the brink of a recession? How can you unify a monetary policy? And that's not just now. I mean, this was 10 years ago. And I'm looking at now, and I'm seeing some of the same footprints still having a problem, where you see, for instance, certain member countries, whether it's Greece with 1.9% of its contribution to DEP, or if it's Italy now refinancing nearly $500 billion in debt this year. How do you unify a monetary policy without actually having a fiscal policy in place that actually will pull the same strings? And I'm sure I have to ask Alberto this because you actually live there. So
the point is that so when I started studying at Bocconi, which is University in Milan, so the very beginning, in 1992, so when the euro was, at the time was also called ECU, and so it was very clear since then that you cannot have, so you cannot give up monetary policy unless you are doing something with fiscal policy, and this is this is exactly what is happening now. Honestly, I'm not very concerned about the fact that you have a country like Ireland with 6% of inflation and a country in recession. So this is, I mean, I think this is happening in the U.S. as well. So you have area in the U.S. where the economy is, going like a bull, and you have areas in which maybe so people are simply moving because they lack of opportunities. Okay, so the point is that from one side in Europe we lack international mobility. So it's very difficult from, so if you are living in a mid-size Spanish or Italian city, so it's very difficult that you pack everything on your minivan and you move to Germany. So and of course, so this is an argument in favor of having more coordination in terms of fiscal policy. No?
Right.
So my idea is that so we lost basically 10 years because we had 10 years to think of how to cope with that. So I'm sure that academy is full of excellent papers dealing with this issue, but the point is that again, so because of lack of leadership, because everyone just wanting to look after their own small domain. So, but in a sense, I mean, the original sin is the fact that so the one that had to decide to give up the power, in fact, are the one that are so. They have to vote against themselves. So if I'm the president of France, I should vote against the fact that I have power. Because if I am giving up my fiscal, my fiscal tools, so then I'm voting against myself. No? So in my sense, so that's why I think that we lost all these 10 years from 1992 when the Maastricht Treaty was signed to 1999 to understand exactly what to do in a situation like this one.
Right.
Now things are getting more complicated. But as usual, I mean, you should look at a crisis as so the crisis is always a great opportunity. In Italy, in last October, November, December, so situation was so tense that in fact it was so I think it was so the very difficult moment that brought us, I presume, the possibility to become a much better country, and this is exactly what I'm hoping for Europe. No, so because otherwise, otherwise, what else? So what is going to happen? So should we come back to the regional currencies? So, but for example, I mean, the German, they would be destroyed because if they had the Deutschmark right now, so the Deutschmark would evaluate dramatically against all currencies, and they were not able to export one single egg. So that's so that I think so. This is to me a great opportunity. So what I think we should expect is that the current leaders should give up at least a little bit of their I would say very short-term interest.
Well, I'm from Switzerland, so you know, I'm dealing with the Swiss franc, and I have no complaints so far. So, just kidding. But I want to use this segue actually to introduce somebody that could speak to this topic even more. I wouldn't say that more, but has definitely some interesting insights. And his name is Ferenc Karvalatis. I apologize for my pronunciation. Karvalic, pardon. He's the deputy governor of the Hungarian Central Bank, and I'm absolutely certain that he can add great and valuable views on this particular topic. So, David, do you want me to? How do you want to do this?
Well, we just spoke, and I think it might be a good time for a short break, and then we start after the break with Mr. Carvalho.
All right, great. So thanks again for your time and your questions. And I'm sure the panelists, as well as myself, have certainly time to answer any other questions. Thank you.